Solar panel makers like Waaree Energies and Premier Energy surge in trade after U.S. Commerce Department announces a fresh round of duties on solar import from Southeast Asia. Nikhil Nigania, director and senior analyst at Bernstein, joins us now to decode this as well as talk about some of the recent listings as far as the renewable energy space are concerned that have done very well. Nikhil, first up, if you've had a chance to look at the news, we have been discussing off late about how Indian players especially are benefiting from various protections, from government, both within India and also some of the export players like USA who are benefiting from duties that have been put on Chinese origin players, especially in the module as well as panel places. How are you looking at the space, and do you feel that these duties can further aid the kind of growth that Indian companies have seen?
Sure. So if you look at the Indian solar cell and module players, especially the two specialized entities listed recently, Waaree and Premier, the benefits they are getting are twofold. So the second and third largest solar installations in the world are happening in US and India. And both these markets don't want modules made in China, which is making 90% of the modules globally. So that way, the domestic players are in a very sweet spot, given protective measures in India due to an ALMM list, which is there. So hence, you have to use Indian-made modules in utility-scale projects. And similarly, in the US, there have been duties imposed on imports from China. Now, the second part, which is the latest news which has come, is now regarding Southeast Asia. So what US is doing, so this is not a new development. This is a development which has been ongoing. This is a preliminary confirmation by the US Department of Commerce on putting anti-dumping duties up to 270% on solar cells made in Southeast Asia, specifically Vietnam, Malaysia, Thailand, and Cambodia. So what was happening is Chinese companies were setting up manufacturing facilities in those markets to ship product to address the US demand. Now, this fresh round of duties, which is being in the process of being implemented, would be imposing up to 270% of duties on those Southeast Asian countries as well, specifically on solar cells and modules made of solar cells made in those markets.
Understood. So, Nikhil, currently two players, Waaree as well as Premier, they are the ones that are doing very well. And, even post the recent listing, the stocks have given significant return. So, number one, you've also recently done a valuation exercise. So, valuations, where do they trade at currently? Are they justified? And do you see further scope as far as stock price movement is concerned?
Yeah. So, specifically on their valuation, we won't be able to comment. But on relative terms, if you see, from a capacity standpoint, let's take a Waaree Energy for that part. The capacity is about 13 gigawatt and has a enterprise valuation of close to $10 billion. Similarly, if you look at Chinese companies like JA Solar, for example, they have substantially higher capacity, close to 90 gigawatts across module, cell, and even ingot wafer, which is the more capex intensive part. And their valuations are similar to what Waaree Energy trades today. Now, in terms of our view on the sector going forward, so we think right now in a very sweet spot. But going forward, we see a supply glut happening in India as a lot of companies are entering this space. It's easy to enter. Doesn't take too long to set up a solar module or even a solar cell manufacturing plant. And the barriers to entry are low, right? So we see supply glut happening in India. And even in US, there's a government push to set up a US-based solar module manufacturing facilities, cell manufacturing facilities, which could hurt the US export story for these players as well in the medium to long term. So we think the next 1-2 years is a very sweet spot, but post that, there could be challenges both in domestic market and in the export market in this area.
Nikhil, good afternoon. Thank you for joining in. That is what I was coming to, right? There's this overhang that persists from the new administration that is coming in the US with regards to these solar companies. And the second part being that now that you mentioned that the competitive intensity is going to rise with the fact that barriers to entry are low. Now, when it comes to execution, right, it has to be earnings that should justify the valuations. With these recently listed companies, the way they have run up, do you think that in the middle of all of these, in this rising competition and this overhang that comes in from the new administration in the US as well, do you think that they will be able to deliver on these lofty expectations that the street has?
Again, so very hard to comment on valuations, but yeah, I think earnings near term for these companies should be good, right? Because of the protective measures both in India and US. Even, if you look at rooftop solar scheme, which the government has, it is incentivizing domestically made, cells and modules. So they are in a sweet spot for the near term. So near-term earnings should be good, but medium to long-term is where we think the concerns are, and if that puts the valuation part in question.
Understood. Nikhil, so, we've covered solar cells, solar modules, in the solar value chain. But one particular company that we need to discuss is actually NTPC Green Energy. When the company listed at a market cap of close to 91,000 crore, even then, the street was of the opinion that for a company with a capacity of close to 3.3 gigawatt, the IPO was perfectly priced. After that, it's up almost over 30-35%. NTPC Green, we know you don't have formal coverage on the stock, but what is it that you can share, and does it have a right to win, the company themselves have been saying?
No, fair. So firstly, on the fundamental part of NTPC Green's right to win in the renewable space, see, renewable is a relatively simple business to do, especially compared to thermal. The biggest differentiators one can have, number one is cost of debt. Number two is land. And number three is receivables. And number four is transmission. Right? So especially on cost of debt, NTPC Green does have an advantage against the private sector players. They borrow money at 150 basis points or even lower than the competitive private sector players. So in a sector which is 80% debt funded, 20% equity funded, that is a big advantage for a player to have. Second, even in terms of land, they have got a good land parcel. As per us, I think about 50,000 acres is what we could read from the DRHP. They have access and they have transmission with it as well. And lastly, on receivables as well, NTPC, what we understand is a tripartite agreement with RBI and state governments, which gives it a priority on getting receivables on time. So all of that fundamentally puts them in a strong place. But to your point, when on the valuation front, when we cover NTPC, the parent, in our SOTP, we ascribe a lower value than what it is trading at for the parent entity. Yeah. And we are positive on the parent, but the portion of value allocated to renewables in our valuation is lesser than what it's at.
Nikhil, I think most analysts will now have to go ahead and give a higher value as far as the parent is concerned, NTPC itself, given the fact that, they have so much higher capacity. NTPC Green, still a nascent company as far as operational capacity is concerned. Nikhil, one last question. You track the entire space. What are your top picks? And as far as FY25 is concerned, or FY26 is concerned, what is it that you'll be looking for, especially in terms of announcements in the power space?
So top picks continue to be actually public sector entities in our coverage. So NTPC is one name we like still. And I think, especially given the green valuation, it looks an easier option to buy right now, NTPC, the parent. The second space we like are the power sector lenders, PFC, REC. They are cyclical plays. They obviously carry higher risk than what an NTPC does. But we think they're a good cyclical play and leverage play into the power cycle. Strong loan book growth, low risk of NPAs. And reversal of provisions, which we expect to continue. So those are the names we like. Power Grid is another name we like, though the key catalyst we had been playing for was, their capex guidance going up, so which has happened already. Hence, our preference would be more towards the first three names I mentioned. Now, coming to the second part of the question, what to look out for next year. See, more than policy, what we are all waiting for is power demand to sort of start picking up. Last 3 to 4 months have been slow. Largely due to monsoons and cooler temperatures. But power demand is, the fundamental driver of capex and growth in this sector. And our longer-term expectation is of a 1x real GDP kind of a power demand growth. And that's what we are waiting for coming in the coming months, December, Jan onwards. So other than that, on the policy front, not a lot, to be honest, at this point on our radar. I think the thermal announcements already, our 80 gigawatts addition are in place, a transmission plan already out there. So nothing major we are waiting for on the policy front as of now.
All right, Nikhil, thank you so much for sparing time and joining us today to share your views on the sector as well as your top picks there, Nikhil Nigania of Bernstein. Well, time for a short break. Up next, we get you more on the markets. Deep Shah of SBI Securities joins us on the other side.